What we are observing are increasingly intense and disruptive natural disaster events. LA wildfires, floods in Europe, hurricanes, Helene and Milton, for example, come to mind. And what we need are pragmatic and impactful solutions.
Welcome to Sustainability Leaders. I'm Michael Torrance, Chief Sustainability Officer at BMO. On this show, we will talk with leading sustainability practitioners from the corporate, investor, academic, and NGO communities to explore how this rapidly evolving field of sustainability is impacting global investment, business practices, and our world.
The views expressed here are those of the participants and not those of Bank of Montreal, its affiliates, or subsidiaries.
I'm Alma Cortes Selva, Senior Advisor at the BMO Climate Institute, and today we're exploring climate risk analytics that can help organizations prepare for physical risk and natural catastrophes. Joining me today is Viola Lutz, the head of the Moody's Climate Center of Excellence. Welcome to the show, Viola. Can you tell us about you, your role as the head of Moody Climate Center of Excellence, and what inspired your focus on climate risk and resilience within the financial sector?
Thank you for the invitation, Alma. Super fantastic to be here. So I had the Moody's Center of Excellence on Physical and Transition Risk. And what we really are is the Moody's-wide place where subject matter expertise on physical and transition risks comes together. What we are observing are increasingly intense and disruptive natural disaster events. LA wildfires, floods in Europe, hurricanes, Helene and Milton, for example, come to mind. And what we need are pragmatic and impactful solutions. Now, combine that with the question of what some of the core functions are of financial markets. Well, it's assessing risk, and on the back of that, channeling capital and transferring and diversifying those risks. And this is, for me, really what can be brought together here. So it's the capability of financial markets that we need to increasingly utilize as societies to solve these channels and challenges. So it's about increasing economies' resilience to natural disasters that requires insights on trade-offs and to also navigate the question of potential adaptation and resilience investments. And I think the financial sector really can add to understanding risks and cost benefits of prioritizations.
Thank you, Viola. You mentioned that Moody's is working extensively on physical risk analytics. Can you first explain, because you mentioned it several times, like what is physical risk analytics and then why it matters for investors and then businesses?
I love that follow-up question, Alma. I'd say let's start with the what. We've partnered a lot with our customers. Ultimately, you simply need to observe what's happening on physical risk management. How is that evolving? And from that, understand what needs are coming along. And I'd say, ultimately, there are three core needs that we see. One is understanding of direct damages. So what is the potential scope of a physical risk? All that is good and nice. What you need to do next is, though, to understand the context. So fair enough, this is the physical risk, but what does this mean in terms of my business decisions? And from there, we're talking about businesses, financial and non-financial ones alike. So we need to think about opportunities. How do these risks now change risk management strategies? So think, for example, about diversification or risk transfer or the assessments of counterparty financial profiles. So this is the what of what actors are interested in. Now, moving to the why. So why does it matter for investors, for businesses? And I actually keep going back a little bit to our mission at Moody's, and that is to be the leading source of relevant insights on exponential risks. And navigating risk is more complex than ever at large. Forget about physical risk, right? In general, it's a very complex risk landscape that needs to be navigated. And we can't deliver such insight without also considering physical risk. And what we've done over the past years at Moody's is to really embed physical risk into financial workflows. And that's really insight that draws from decades of catastrophe modeling expertise from our acquisition of RMS. The key element to make here is these insights aren't theoretical. They are very much actionable.
If I'm hearing correctly, then there's no single indicator for a financial institution, more it's institution dependent and organization dependent, that they should be looking at, just because there's so many risks and so many things happening.
Absolutely. I do think that it very much depends also on the persona and the use case. So the specific challenge you're trying to solve, what view, what metric on risk is the most relevant. So I would absolutely agree with that. I think the underlying analytics in the spirit of having the physical risk damages, so for example, the hazard depth, right, flood depth, and then translating that into financial impact like building or content damage is always the core. But then how do you translate that into the context that is relevant for a specific institution or for a specific function in an institution that might differ? To make an example, right, if I'm an underwriter, I might be interested in a different metric and context than if I'm a credit portfolio officer or a chief risk officer. So those are the nuances where I think to make data and insight consumable, you need to transform it into this perspective that is relevant to decision making.
Thinking about the topics of interconnected risk, resilience, and a complex future, AI comes to mind as a particular thorny challenge, but also as one of the most transformational areas of opportunities. How is AI impacting Moody's in terms of your work and your customers, as well as the organizations?
Well, first of all, let me say I love the framing as a thorny challenge. I think it's also a thorny opportunity, and I do want to come back to that point specifically in a moment. I think in terms of how it's impacting us more broadly in terms of work, customers, business, I'm thinking of it almost as a twin engine. So it's an enterprise transformer and a domain amplifier. And this is heavy work with word here, but practically speaking, AI is changing how we work and what we can deliver. And it's doing that at scale because we can combine it with trusted data, guardrails, super important, and then the deep domain expertise. And what that translates into are three things. Let me firstly speak about company-wide effects, then maybe what that specifically means on the climate innovation side, and ultimately customer outcomes, because that's what we are working towards at the end of the day, right? So company-wide, we are focusing on deploying Gen AI where it drives measurable outcomes. So that can really be across search, analysis, workflows, all of those dimensions. Crucially, we're doing it with accountable and transparent principles and strong governance. And the question now is, what does that translate into for the field of climate specifically, for example? So a couple of specific projects and implementation areas that we're having. What we're, for example, building are targeted AI assistants to cut response times and improve consistency and also access to information and how easy it is to digest. Because sometimes we're dealing with quite complex methodologies. So what you can think about are, for example, post-sales regulatory stress testing helpers or methodology assistants that can be used internally by colleagues, but also, of course, externally with clients. And we are also testing how to use AI to bring event response analytics to a broader set of clients. And with event response, we really mean post-disaster analytics. And we are already doing that quite extensively in the insurance industry. And we're seeing that there's interest by more sectors and players to also gear up and increase capacity on that topic. Now, ultimately, of course, we want all of that to drive customer outcomes. So faster insights, clients want broader coverage. They want to ultimately take decisions with more confidence. And there's actually quite an interesting statistics that I like from our research assistant. So that's not a climate initiative, that's a Moody's-wide initiative. And this research assistant helps users access up to 60% more data with around 30% time savings without sacrificing any traceability. And that's really because it's grounded in Moody's content and data governance, which allows kind of the access on the one hand side, but then also the guardrails. I do want to maybe before concluding on this question, come back to the point that you made about thorny, because as I said, it's a thorny opportunity. It's a thorny challenge. And I think specifically so in a complex, regulated space, because with the type of data and insight we deal with, how you innovate matters just as much as what you build. And what we do as a company, we do invest a lot into principles and policy. So we publish clear AI principles and support customers' own compliance journey. For example, on materials for the EU AI Readiness, AI Act, and readiness for that. And we do also have a lot of enterprise controls. So we've invested in controls like prompt security, data loss prevention, and we have internal governance structures that we convene to monitor risks. Because ultimately, well, first and foremost, seriously, you need to make sure that adoption doesn't outrun safety, because otherwise you're not creating an opportunity.
Thank you. You mentioned post-disaster relief. Is that also part of AI-enabled solutions that track event footprints in real time?
Yeah, I think excellent question, and also very timely. I think we've seen a number of just very large and unexpected catastrophic events. And so a lot of business leaders, of course, also communities, but in the case of the actors, we work a lot with business leaders who are wondering, well, how can we in more detail and quicker make sense of that and what it means? So I would say these type of event footprints are really not only tech, they are business continuity enablers at this point. And maybe just for the broader set of listeners to give an idea what we're talking about, there's almost like an insurance baseline, meaning that insurers are very used to tracking natural catastrophe event footprints. And Moody's has a very established so-called event response business. So what we do, we produce, for example, hazard footprints and portfolio exposure analytics. So that means where is an event likely to hit? What is it hitting and how hard? And what might losses look like on the back of that? Now, what we're thinking about is how can all of that intelligence serve actors that are not insurers? And what we're doing is we're piloting POCs that extend this logic to other user groups, for example, to banks. Again, with the idea that they can see evolving risks as an event unfolds. And while we're POCing that, for example, what we've already able to leverage and what we are building on with these type of efforts are in banking, for example, that we already have AI-powered loan monitoring solutions that help customers to proactively identify and mitigate portfolio risks with advanced early warning and covenant management tools. So this is where, for example, the power of AI in vast data sets supports risk prioritization by identifying trends and patterns across your portfolio and allowing for swift intervention. Now imagine that overlaid with data on an unfolding event. They could observe and react to the impacts really as they evolve, meaning translating it into the financial metrics and insights that we were speaking about earlier. I think that really what we'll see more and more is that our deployment of technologies will fundamentally shift risk management practices from reacting to market changes to proactively preparing for them.
I was really interested in what you mentioned in event response business. Let's say that like a wildfire happens in California or it happens somewhere in Canada. What kind of indicators, what kind of metrics then would a business get for an event on the ground?
I think different elements. So I think crucially, first of all, what are the hazards that are being realized? And I think then you need to overlay that with what we call exposure. So what are the type of buildings and what are the characteristics of those buildings that are impacted or in the way of the event, depending on the event, right? And knowing that, for example, well, we have detailed information in terms of what wind speeds, for example, are associated with what type of damages. So then in turn, translating that into these potential damages and also what type of damages. Is it a building damage? Is it business interruption? Is the content of a building may be damaged? So those are some of the key metrics. I think the next physical risk metric that I always find very important is to also think about tail risk. How unusual or how extreme is this event? Am I ultimately seeing something that sort of just can happen in an average year with a relatively high probability? Or is something unfolding that is actually quite rare in its either timing or severity, right? So those are, I think, the elements that you can get. And then this is sort of almost the direct damage from physical risk element. The next step that then business leaders are looking for, and using the earlier framework, is really the context. When I use that to look at my specific portfolio, what type of metrics is that aggregating into? And this is, of course, where different use cases and different user groups have different interests, right? The type of metrics from an insurance company would differ from a bank, right? A bank might want to know what really the losses are, expected losses, maybe what is covered by insurance policies or not. So this is really where it becomes quite specific to what a client wants to understand.
That makes complete sense. Now, natural catastrophes, like you said, are becoming more frequent and severe. There's no question about that. You keep mentioning being prepared.
Yeah.
What does that mean?
Ultimately, you need to understand the risk. I mean, if you don't understand it, what are you even talking about? Then you need to frame it in the business context. If you don't know why it matters and how it matters to your business, you got homework to do. And then you need to weigh the risk exposure, because maybe some risks you want to take or you're accepting to take, others you might want to mitigate or completely eliminate. All of that for me ultimately is the foundation to think about the opportunities. The opportunities are take better decisions on risk management, but also what is the type of activity I want to be in and in which geographies. And de facto, well, today's very fast-moving environment. And balancing competitiveness and resilience is actually quite challenging. So it's not just managing the risk itself, it's doing so while staying agile, relevant, and profitable. Let's say one key shift that we have seen also really links back to our interconnected risk discussion right at the beginning. And that is banks are acknowledging that risk categories can simply no longer be viewed in silos. So a credit event can trigger liquidity pressures, which in turn become capital issues. A cyber breach can quickly spiral into reputational damage. So the interdependencies are real, and they are increasingly visible across all levels of hierarchy.
How do you see collaboration between the analytics, finance, and then policy to accelerate climate resilience? Because that's about being prepared. So how do you see that working together, especially in the current framework? The EU is on one track, the US is on another track, Canada is in another track. How do you see that working?
I think it's a very interesting question. And for me, at the core of it is almost the underlying question on climate resilience and how we create a systemic step as, yes, financial actors, but also as financial systems, as economic systems, and as social systems, well, as societies, right? I think collaboration between analytics providers and financial institutions isn't just about better models. It's really about enabling the systemic shift in how risk is understood and managed. And for me, key to that is to get the individual pieces right and the foundation. Now, climate risk is business risk. And to understand that consistently, you need a common language of risk. Because I think what we're facing today, even in the sort of cosmos of the financial system, right? If you think about the economic and the societal system as kind of larger spheres, and then within that, the financial system, the different types of actors often use distinct metrics. I mean, a flood doesn't care whether the asset is collateral for a loan or covered by a policy. So when analytics can bridge those perspectives, we unlock new possibilities, meaning shared frameworks for resilience, better capital allocation, and even incentives for adaptation that reduce risk for everyone. And this isn't theoretical. This is where we can be already today. It does require, however, models validated for regulatory use, granular spatial resolution, and partnerships that combine this domain and subject matter expertise with technology innovation. And I think if we get those pieces right, collaboration can really become a catalyst for systemic resilience, helping financial markets move from fragmented responses to more coordinated strategies that really focus on protecting stability and enabling growth in a changing climate.
One last follow-up question. You normally speak in broad terms. Are there differences in the geographies on how you think we should be dealing with integrating mainstream financial decisions given the different landscapes in policies? If you are in the US, should you be going one way about it? In the EU, a different way because of policy decisions? Canada, do you see regional differences, or you should think it's more like a holistic approach?
I would almost say both, but I think first and foremost, I think of it as a holistic approach because a flood is a flood is a flood. A hurricane is a hurricane is a hurricane. An industrial power plant doesn't know neither politics nor policy. And I see globally, from APAC to Europe to North America, business leaders who very practically seek to understand what can hit my business and should I be worried? And they want answers on that. And that means integrating analytics on natural catastrophe events into their business as usual risk management processes, governance, due diligence. And that really goes a little bit back to my vision. And I do see that increasingly happening in financial institutions. And it's almost, let's make this topic boring. It's nothing special. It's nothing out there. All of these professions, all of these business leaders talk risk all the time. Well, welcome to a world where you add another dimension to that, which is physical risk, natural catastrophe event risk. So I think this is really what working globally with financial institutions across sectors, with non-financial corporates, what I see, it's very pragmatic decisions that think first and foremost, what do I need to do to run a profitable and resilient business? And I think that doesn't differ that much.
I agree with you. Thank you for sharing your expertise. As we've discussed, physical risk from heat waves to natural catastrophes are no longer distant possibilities. They're present realities about how we design, operate, and finance critical infrastructure. This has been the Sustainability Leaders podcast, and then thanks for tuning in, and we'll see you next time.
Thanks for listening to Sustainability Leaders. This podcast is presented by BMO. You can find our show on Apple Podcasts, Spotify, or your favorite podcast player. Press the follow button if you want to get notified when new episodes are published. We value your input, so please leave a rating, review, and any feedback that you might have, or visit us at bmo.com/sustainability leaders. Our show and resources are produced with support from BMO's marketing team and Puddle Creative. Until next time, thanks for listening and have a great week.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer